Welcome to Stock Investment Analysis. In this video, I'm going to cover my top 3 best stocks to buy for July. I already own all 3 of these stocks and I'll be buying more throughout this month because they are at a good value and are set for enormous growth. If you want to make over 30% annual returns, make sure you watch this video to the end. One of my favorite stocks has more than a 40% dividend growth rate. Unlike my in-depth analysis videos, today's video will be giving more of an overview of why I am buying without going into as much detail. That way I can cover all 3 stocks in this video without making it take too long. However, I am planning an in-depth stock analysis video on all 3 of these stocks in the upcoming weeks, so make sure you subscribe and hit the bell so you don't miss a single one of those. These videos take a ton of time to make, so please hit the like button to get this video out to more people who are interested. My first stock for today is the only one that does not pay a dividend. You already know Amazon. It's a huge company with a $1.44 trillion market cap, and shares are trading at $2,890 per share now. The first 2 things you might think when you hear about Amazon is that it's way overvalued and too late to buy, and that Amazon is the big tech story of the past. Why invest in Amazon when there are so many smaller, newer tech stocks? Let me illustrate for you in a few charts why Amazon is an amazing investment right now and why I'm adding to my position even though my cost basis for Amazon is only $1,377. People look at charts of Amazon like this one on Fast Graphs. You can see that the earnings are in dark green at the bottom and the black line is the price. It looks like Amazon is absurdly overvalued because the price is so high compared to the earnings. In fact, the blended price to earnings ratio is almost 138. If I look on Fidelity, it shows the price to cash flow ratio is a 44, price to sales is almost a 5, and price to book is over 24. It is overvalued compared to its peers when you see this at the 75th to 96th percentile on these valuation metrics. When you see that, you may think, Amazon is a terrible buy. Bear in mind, if you look at Amazon's earnings up until 2008, for example, it looks like it was overvalued and a terrible buy back then too. Yet despite that, since 2008, it has 41.4% annual returns. In other words, if you are waiting to see a good PE ratio for Amazon, you will wait a long time and probably miss a lot of growth. In fact, you can see investors are not using PE to value Amazon, given the price appears to have no clear relationship with earnings much of the time. So if price does not follow earnings well, what does price follow for Amazon? Check out EBITDA, or earnings before interest, taxes, depreciation, and amortization. You can see in this chart that the price follows EBITDA beautifully. In fact, EBITDA growth over the past 20 years has been 33.09% per year. What is their share price appreciation rate? 33.3%, a very nice match. This is a much better valuation method for Amazon than earnings and a better way to predict where the share price is going. Speaking of which, based on EBITDA, where does it look like the share price is headed? If you look down here, analysts are forecasting 47% EBITDA growth in 2020, 37% in 2021, and 24% in 2022. You can also see that right now the black line is right around the orange line. The orange line is the average price to EBITDA ratio for Amazon. That means if it continues at its current valuation, much as it has for the last 20 years, we could see a 35.2% annual return until the end of 2022 for a total of 112% growth. Not too shabby, is it? Looking at past performance, given that 33.3% annual return for 20 years, $10,000 invested 20 years ago would now be worth an insane $1,530,067. Compare that to the S&P 500 $33,428 for the same time period. Fidelity's S&P Global Market Intelligence considers it slightly undervalued, very high in quality, low on growth stability, and average for financial health. Let's take a look at a discounted cash flow model using EBITDA on Finbox. Finbox has some excellent tools, and we can see here that, based on a 5-year discounted cash flow EBITDA exit, Finbox calculates an amazing 78.1% upside, which places fair value at $5,147.79 per share. Also, just in terms of growth, note that 16.9% revenue 5-year compound annual growth rate, the 16.8% average EBITDA margin, and 76.5% unlevered free cash flow 5-year growth rate. In other words, for those who think that they may have missed their opportunity for Amazon and need to wait, I disagree. I will be adding to Amazon this month and I'm excited for those potential returns. For my second stock choice, I give you ABBV. I have so much to say about ABBV, so I again encourage you to subscribe to see the in-depth analysis of ABBV I'm working on. We'll be going deep into all the typical valuation and growth considerations, as well as talking about Humira and its patents, the pipeline, debt, and the Allergan acquisition. There's a lot of interesting developments I believe many of my viewers are unaware of. For the sake of this video, just know that AbbVie is a pharmaceutical company and a dividend aristocrat from its spin-off with Abbott Labs. Some of their most well-known products include Humira, Depakote, Synthroid, and Imbruvica. On fast graphs, we can see the normal blended PE for AbbVie since 2012 has been a 13.79. Prior to 2018, it followed earnings quite closely. Due to recent developments, which I'll discuss in the in-depth video, the share price declined recently before beginning to rebound. What this means is this is a stock which is currently unreasonably undervalued and expected to continue to grow quickly with 16% earnings growth this year, 15% next year, and 12% growth in 2020. If it returns to fair value by the end of 2022, which I believe is quite likely, we would see 32.1% annual returns until that time, including the dividend. The dividend is currently yielding 4.77%. Speaking of the dividend, look at that dividend growth. The compound annual growth rate is 40.8% for their dividend. While this is largely because of the enormous 300% raise in 2013, it is important to note that they have raised it by double digits every year but one, and they raised it by over 50% in 2018. It has an 18% total annual rate of return compared to the S&P 500 12.6%. Fidelity's Global Market Intelligence rates it as a fair valuation but sees quality as extremely high, growth stability is high, and financial health as extremely high. Let's return to Finbox to see their 5-year discounted cash flow growth exit. Based on their data, they see a 19.4% upside and fair value is at $118 per share. Compare that to the current $98.88. Again, note the impressive growth with a greater than 10% revenue growth rate, 48.5% EBITDA margin, and 66.7% unlevered free cash flow growth rate. Finbox allows us to consider valuation using a second method using PE multiples. Based on PE multiples, Finbox calculates a fair value of $133, which is a 34.5% upside. This is very similar to what we saw in fast graphs. Finbox also uses these pharmaceutical rivals as benchmarks. Looking at the benchmark companies further, AbbVie's projected net income growth for the next fiscal year is 122%. The 5-year forward compound annual growth rate is an impressive 22%, although it slows to 9.6% for a 10-year forecast. You can see their current trading multiples listed here at the bottom are more favorable than all of their rivals with a single exception, as Gilead's enterprise value to forward EBITDA ratio is slightly better. Market cap to forward revenue and the forward PE ratio is better for AbbVie than any of its rivals included here. Our third stock I am buying this month for huge future returns is BristolMyers Squibb, ticker BMY. BristolMyers is a global biopharmaceutical company with major drugs like Eliquis, Plavix, Opdivo, and Orencia. Similar to AbbVie, if you want more information about this company and why it is expected to have significant future growth, subscribe to see that in-depth analysis video coming in the future. Speaking of significant growth, in 2016, the company grew earnings by 41%. In 2018, it grew earnings by 32%. This year, it is expected to grow another 32%, and we are expecting another 19% next year. This is coming at a time when this company's share price has fallen. Although it has recently recovered, you can see the black price line is well below earnings and the orange fair value line. When we buy well below fair value, we can expect better returns and a greater margin of safety. Although the black price line has generally followed the earnings in dark green and that orange fair value line for the past 20 years, there have been exceptions. In moments of exception are opportunities to lose or make money. For example, what if you had bought Bristol-Myers in 2007 when the price was above the earnings fair value line? If you had held it until today, you have received 7.2% in annual returns. Not too bad, but not amazing either. What if you had waited 1 or 2 years when the price dropped lower than the fair value based on earnings? Waiting until the beginning of 2009 when it was below the fair value line and holding until today would have given you a 13.3% return. While it may look like a small difference on the chart between those 2 points, waiting until it was undervalued would have nearly doubled your returns. Had you bought any time in 2013, 2014, 2015, or 2016, you would have been buying at a time that the stock was quite overvalued and well above the earnings. Although it continued to climb without any earnings justification for years, eventually the correction comes. Those who bought during those years of overvaluation are likely still down or have only just begun to break even. Buying now, or better yet, buying back here, gives us an opportunity like the one I showed you back here in 2009. This is why we want to buy when stocks are undervalued. If we buy now and share price returns to a fair value of a 15 PE by the end of 2022, we will see a 34.7% annual return, which is over 100% in returns in just over a couple years. They have an A+ credit rating, $133 billion market cap, 44% long-term debt to capital, and they have a 3% dividend yield. When we look at their performance, you see that their dividend yield has grown at a far slower rate than ABBV with a growth rate of 2.4%. It has historically underperformed the S&P 500 by just over 0.5%. While that may not seem as impressive as Amazon or ABBV, it is the future growth we are more interested in than the past. Using FastGraph's forecasting calculator, FastGraphs is predicting nearly 32% annual returns until the end of 2023 for a total return of around 150%. Fidelity's S&P Global Market Intelligence considers Bristol-Myers to be extremely undervalued, of very high quality, quite low growth stability, and extremely high financial health. Switching over to Finbox to get a sense of their valuation and growth assessment using their 5-year discounted cash flow growth model, they consider a share price of $69.35 to be fair value. Given the stock is currently trading just over $59, that's a 17.4% upside. Note here that revenue has grown at 13.4% annually, EBITDA margins are at 44%, and the unlevered free cash flow growth rate is at 76%. So in summary, based on valuation and analyst forecasted estimates, we may see 35% annual returns for Amazon, 32% returns for ABBV, and almost 35% annual returns for Bristol-Myers Squibb until the end of 2022. That sort of growth is perfect for my portfolio. I hope you enjoyed this video and this has given you some ideas for your own investing. What stocks do you plan to buy in July? Please let me know in the comments below, and remember, I am not a financial advisor, this is just for entertainment purposes. Make sure to subscribe because I am creating new videos for you every week. As always, good luck with your investing.